Booking Holdings is down more than 20% this year. And yet, this company booked 1.2 billion room nights last year. So why is the stock falling? The market fears AI. The fears that ChatGPT or Gemini becomes your personal travel booker, cutting out Booking.com entirely and going straight to the hotel. But what if that fear is wrong? A Moat tells us whether a company can defend its profits from competition. Booking's moat is built on scale and network effects, and it's still one of the strongest in travel. It connects over 4.5 million properties with more than 500 million monthly website visits. That scale matters because hotels list where the demand already is. More hotels bring more users bring more hotels, and that loop compounds. This was built over decades by dominating the most fragmented part of travel, independent hotels that rely on booking for demand. Now to the real question, AI. The bear case is simple. If AI assistants become the starting point for travel, they could route users directly to hotels, bypassing booking entirely. That sounds powerful, but booking travel is not just search. It requires payments, refunds, fraud checks, compliance, live inventory, and customer support. Today, AI can recommend, it cannot complete the transaction end-to-end. Booking argues this means AI still needs a fulfillment layer and Booking already is one. Booking also adds some stickiness through its Genius loyalty program, which increases switching costs once users build history on the platform. But this is not an unbreakable moat forever. Direct booking is growing, and AI agents could eventually connect directly with suppliers. In the near term, Booking's position in the fragmented hotel market remains very strong. Millions of small properties still rely on it for demand, so the moat is still intact, but it's being tested for the first time in decades. Every data point in this video comes from Fiscal AI, the platform I use for every analysis on this channel. Link in the description for 15% off. Returns on capital tell us how efficiently management converts investor dollars into profit. Booking is exceptional here. Return on invested capital sits at 51.6%, far ahead of peers like Airbnb and Expedia. That level of return signals a highly efficient platform business with strong pricing power and low incremental cost of growth. On return on equity, there's a distortion worth explaining. Booking's aggressive share buybacks reduced equity to the point where it became negative in 2023, making return on equity not meaningful for comparison. That's not a red flag, it's capital return at scale. Management choosing buybacks over retained equity. So the real signal is return on invested capital. And at over 50%, it shows a high quality business. Even great businesses need growth to create value. Booking has delivered steady long-term compounding. Revenue has grown at a compounded annual growth rate of 10.7% over the past decade, with net income tracking at roughly 10.9%. Earnings per share have grown faster at 16.3%, mainly driven by share buybacks, reducing the share count over time. Peers show different dynamics. Expedia's higher earnings per share growth is partly a recovery effect from post-COVID lows, while Airbnb became profitable in 2022 and has grown slightly. Looking forward, analysts expect Booking to grow earnings at roughly 29.4% annually through 2028. Recent geopolitical tensions in the Middle East have reduced near-term guidance, but most long-term estimates still assume this is a temporary headwind rather than structural damage. A strong balance sheet gives a company optionality when conditions change. Booking has both strength and flexibility here. It holds around $17.2 billion in cash against roughly $19.3 billion in total debt, meaning it could almost cover its entire debt load with cash alone. Free cash flow of about $9.1 billion annually means the company generates nearly half of its total debt value in cash each year. That puts its debt paycheck period at roughly 2 years of free cash flow. This is extremely strong for a company of its size. In short, the balance sheet is not a constraint, it's an advantage. Even the best business can be a poor investment if you overpay. Valuation is the final filter for our margin of safety. Booking trades at a forward price to earnings of around 16. To avoid distortion, it's more useful to look at the last 5 years rather than a full decade, since COVID created extreme outliers. Over that period, the minimum was roughly 13.5 times earnings and the maximum was 31 times earnings, with a median around 20. At 16, the stock is sitting below its historical midpoint. Compared to peers, Airbnb trades significantly higher, while Expedia trades lower but with a weaker business profile. So Booking sits in the middle, but with stronger fundamentals than the average mid-range multiple suggests. Now the price-to-earnings growth ratio, as forward PE does not account for long-term growth. A forward PE of 16 divided by expected long-term earnings per share growth of roughly 16% gives a PEG ratio of about 1. That's right on the boundary of what is typically considered fair value. Below 1 often signals undervaluation for quality businesses. Between 1 and 1.5 is fair for quality, and above 1.5 is expensive. So the key question is simple. Is the market pricing in too much AI disruption too soon? Because if growth holds anywhere near expectations, the valuation starts to look conservative rather than expensive. Let's bring it all together through our 5 key factors. Booking has a wide moat built on scale and network effects, especially in fragmented international markets. Its returns on capital are best in class, with return on invested capital above 50%. Growth is steady, with 16% earnings per share CAGR expansion supported by share buybacks. The balance sheet is strong, with substantial free cash flow and minimal financial risk. And valuation sits near historical lows at a forward PE of 16. The AI threat is real, but it is long-term, not immediate. Today, AI can help users discover and compare travel options, but Booking still owns the infrastructure that actually completes the booking. The market, however, appears to be pricing in a more immediate disruption than the data currently supports.